MIP has been one of Eastspring Investment's flagship fund for the past 14 years since its inception in 2005. What are the enhancements made to MIP, and why are these changes being made?
Well, we're making some changes to the available investment mix for the Eastspring Investment Fund's monthly income plan, otherwise known as MIP, to improve its ability to weather future market volatility. The fund was established in 2005 with a mix of US high-yield bonds, Asia high-yield and investment-grade bonds, and a small amount of dividend-paying equities. This asset mix really served the fund very well for the last 14 years, as it's been able to achieve its investment objective of paying out 5 cents per share per annum in Singapore dollars. Global interest rates have declined over the last 10 years, and it's becoming increasingly difficult for investors to rely on stable income from a single source of bonds. Hence, a mixed approach of building up a yield from multiple sources of bond income is becoming increasingly important. The original MIP structure had the yield generators in place, such as Asia High Yield, but it did not provide the multi-asset solutions team with enough low volatility or defensive options in case markets face another serious correction. With US equity markets near all-time highs, developed bond yields at all-time lows, any significant negative news could send markets down sharply. In those risk-off market environments, we need to seek investments that are negatively correlated to high yield and Asian bonds. US Treasury bills are the most natural portfolio diversifiers since they tend to outperform equities or high yield bonds through a recession. This is because global investors seek out safe haven investments where returns of capital are guaranteed, even if the yields are low or negative. So adding US Treasuries will help the investment team protect capital during recessions or prolonged market downturns. And we've also widened the definition of bonds in US and Asia to include investment grades and other corporate bonds.
How can MIP help investors in their search for yield and investment income?
Well, we're very pleased that MIP has been able to maintain its 5 cent per share payout since its inception way back in 2005. While that payout, of course, is not guaranteed, Eastspring has been able to maintain a payout during very volatile market environments like the 2008-2009 global financial crisis, European credit crisis of 2011, and the China slowdown back in 2015. So the stability of this payout is driven primarily by the fact that we've been able to generate both capital gains from one side of the portfolio and income from the other side throughout the full investment cycle. But however, adding lower risk government bonds will allow us to better protect capital in downward markets going forward, allowing the net asset value to recover more quickly when things return to normal.
With the rising market volatility and with the global economy entering the late stage of the bull market, how is MIP positioned to navigate through current and future market environments?
Well, the multi-asset team uses a combination of quantitative and qualitative signals to help determine our position in the economic cycle. Our data signals indicate that we're progressing through the slowdown phase, but we're not yet entering into a recessionary phase. While some key signals are flashing amber, including the inverted yield curve and weak global trade and manufacturing data, other signals, on the other hand, remain positive, such as the labor market tightness and rising wage data in the US. So the US economy is particularly important for global growth, and it's primarily driven by the consumer. It's about 70% of US GDP. And the US consumer remains very healthy for the time being. Deterioration in consumer sentiment can happen quickly, but we believe a slower growth scenario remains intact for the remainder of this year and likely into 2020. The market will also likely be supported by increased stimulus measures coming from the major central banks via lower interest rates and possible fiscal stimulus spending packages from China or other governments. The G10 governments in particular seem to be focused on staving off the impacts of a potential recession. And while they may not be able to achieve this indefinitely, they can probably achieve it for another year or two. In the meantime, we, on the multi-asset side, will gradually reduce our position in US high-yield bonds in favor of Asian bonds, both investment grade and high yield, and will increase our US Treasuries position as the global economy creeps nearer to that negative growth scenario. Trade-related data remains very important right now, and any signs of a truce between the US and China in their tit-for-tat tariffs could be positive for the markets and for the economy. The key is that we now have the tools to manage the portfolio more defensively through any slowdown phase or into a possible recession. So increasing our allocation to US Treasuries would help mitigate the negative impact of any prolonged global slump, since they tend to be less volatile than investment grade or high yield bonds. With the fund enhancements, we're also launching a new S-share class. In addition to the regular monthly distributions, the new S-share class can also pay out special distributions over time. For example, if we have any additional capital gains, this will be at the manager's discretion.